Canada Economy 2025 Stagnation Q2 Signals Concern. In the second quarter of 2025, Canada's economy showed clear signs of stagnation. The annual growth in GDP slowed markedly. Canada's GDP annual growth rate in Q2 2025 was 1.20% year-on-year, down from about 2.30% in earlier quarters. This deceleration reflects weakening in several key sectors. On a quarter-on-quarter annualized basis, the economy contracted -1.60% in Q2 2025, reversing from positive growth in Q1 of 2025, when GDP grew around 2.20% annualized. The contraction in Q2 is sharp, and illustrates that after modest growth in earlier quarters, the momentum dropped sharply. Looking at full-year growth, Canada's real GDP grew 1.60% in 2024. Forecasts for full-year 2025 place growth closer to 1.00%, indicating that the stagnation seen in Q2 is likely to weigh heavily on the year's outcome unless later quarters recover strongly. Turning to the interest rate, the Bank of Canada's policy rate remains at 2.75% as of July 2025. The BOC has held steady at that rate through multiple meetings, signaling caution amid uncertainty. Earlier in 2025 there were cuts from higher levels, but since Q2, the overnight target rate has been maintained at 2.75%. The unemployment rate in Canada has deteriorated modestly. In August 2025, unemployment rose to 7.10%, up from 6.90% in July. This marks one of the highest unemployment rates in recent years, contributing to downward pressure in consumption and household confidence. Inflation has also shifted during this period. Canada's inflation rate, CPI, rose to 1.90% in August 2025, from around 1.70% in July. While inflation remains relatively low and within or near the Bank of Canada's target band, modest upward movement in inflation, especially as measured month-on-month, keeps policymakers alert. One of the broader constraints is the debt-to-GDP ratio. Government debt in Canada is expected to reach about 106.00% of GDP by the end of 2025. Private sector debt remains high. Private debt to GDP was around 163.25% in 2024, a slight decrease from about 164.00% in 2023. High debt levels, both public and private, limit the capacity for stimulus and increase vulnerability to interest rate shifts or shocks. Putting these indicators together, the stagnation in Q2 is not surprising. The -1.60% contraction on an annualized quarter basis shows that economic activity dropped sharply in Q2, despite modest growth earlier in 2025. The slower year-on-year growth of -1.20% confirms that the economy is cooling. The steady interest rate at 2.75% implies that monetary policy is neither tightening strongly nor providing strong stimulus. It is in a holding pattern. The BOC faces a trade-off. Cutting rates might help support growth but reduce ammunition if inflation starts to drift upward. Unemployment rising towards 7.1% adds pressure as labor markets soften, which in turn affects consumption and demand. Inflation being low, just under or around 2%, offers some room. However, inflation expectations and underlying pressures, such as supply chain or trade policy-related cost changes, may complicate decisions. The slight uptick in CPI suggests inflation isn't falling sharply, but also isn't surging. This ambiguous environment gives less clarity for aggressive rate cuts. Debt levels, especially high private debt, amplify the impact of high interest rates on households and firms. With debt servicing burdens already elevated, any increase in interest rates, or even an unexpected tightening, could force retrenchment in spending and investment. Public debt, over 100% of GDP, constrains the government's fiscal policy flexibility. Large-scale stimulus becomes more difficult when debt is high, interest costs rise, or borrowing conditions worsen. Other contributors to stagnation include trade headwinds, weaker investment, especially business investment in machinery and equipment, and slowing export growth. These sectors tend to respond sensitively to expectations and external demand. When external demand or trade policy becomes uncertain, investment tends to retract. Overall, Q2 2025 for Canada presents a case of residual economic stress, growth slowing, labor market softening, inflation stable but not falling rapidly, interest rates high relative to inflation, and debt burdens elevated. These combine to create a weak growth environment. Looking ahead, unless there is a rebound in export-led growth, stronger investment, or relief in external constraints, Canada is likely to see continued stagnation or even further contraction in later quarters. Full year 2025 growth forecast at about 1.00% is modest, heavy reliance on Q3 and Q4 performance. In summary, Canada in Q2 2025 shows sharp signs of stagnation, a contraction on an annualized quarterly basis, weakened year-on-year growth, rising unemployment, a steady but somewhat restrictive interest rate, low but creeping inflation, and high public and private debt. The combination underlines that Canada's economy is in a soft patch, with risk of slipping into deeper weakness if adverse shocks occur. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.